When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade, and I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff. That would be Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing great, thank you. October upon us here. Have the license plates begun to change here in the Tucson area, to your knowledge, yet?
Shoot, they were changing to California all summer long. Everybody's coming over here and fleeing the state for whatever reason. But, you know, those ones from the Midwest are winter visitors. Look like they're trying to show up again. It's October. So, I don't know. I always remember it takes me 10 minutes longer to get to the office from October to April. And that's just the way it is. So no big deal. I think, people from out of state like to obey the speed limit and drive slow. The people in state, we just kind of get used to the roads and we just fly along when there's nobody in our way. So, I got to kind of adjust to that. Maybe we'll work on my patience a little bit or just leave earlier and get up earlier. That's one of the things I can do.
That's right. Well, Tucson, a great place to live. Glad everybody could join us here, whether you're a native or whether you're visiting. All are welcome here for Premier Retirement with Jeff Fogan. Before we get started, again, write down this telephone number. You're going to need it, 520-780-9059, 520-780-9059. That's the number that you'll use to talk back to us and to request your retirement roadmap. Okay, Jeff, we were all abuzz a couple of weeks ago, 3 weeks, a month or so when we got the Fed rate cuts, and we were expecting more to come this year. Now, the headline that I'm seeing is why Wall Street's hopes for a big interest rate cut have dimmed, and what's next. Can you expand on that?
Yeah, the fact we got some interesting job news. Of course, we have to kind of assume that everything that comes out of the White House is just BS to try to prop up, their candidate for the next round to continue their agenda and ruining America. But bottom line is that there was about 100,000 more jobs created, supposedly, than were expected. And the thing is you've got these estimates by ADP, which is the biggest payroll processor on the planet, and they can tell how many people get on new payroll, and they can extrapolate that from those numbers and kind of expand them to all the numbers based on all the employers that they don't service, including government jobs and things like that. And so they come in actually really, really close to the actual. And then the White House comes out and their economic department, their labor department, whatever, their reporting is just really twisted. It's really more agenda driven. Then they come out and say, oh, instead of 120,000 jobs, we got 250,000 jobs. Isn't that great? Well, what they don't tell you is how many were government jobs. And I don't know if they're counting green cards to illegal aliens, government jobs, but as long as they're putting money on their debit cards every month, maybe they call that a job, because their job is to vote for the next president and keep their freebies coming. So maybe that's a job. I don't know. They have a lot of healthcare jobs, a lot of government jobs. And if the jobs are expanding in the government so huge, who's paying for all that? I don't think they should even count government jobs, because it doesn't do anything for the economy. It just sucks money out of the working people to pay those. Oh, and by the way, coming back to the ADP versus government reports, and ADP is just, one source, but they've got all kinds of ways that they can come up with this estimate. They've been talking this, Jared Bernstein, the economic advisor, I think that's what his title is. He was like a music major, then he became a politician somehow, and somehow now he's an economics guy who doesn't know anything about economics, but he uses this thing called the birth-death matrix. That's how we're going to figure out how many jobs are created. Well, when you undid that job creation numbers for last year, it was 813,000 jobs that they overestimated or overreported. Oh, wow, that's about, 7,000 or 80,000 jobs per month every time they report. Well, that's about what we got again. So, it's probably fake numbers. But there's kind of a catch-22 to their numbers. One is, hey, the economy's doing great. Isn't it awesome? The interest rates are lower. The Fed only reduced, by the way, they only reduced the short-term interest rate, not long-term interest rates. We've seen that with the longer-term bond rates going back up, even on the 10-year bond up in the 4 range again. We have lower interest rates going down 0.5 point, but hasn't really done anything to uninvert the yield curve. But we should see, interest rates across the board come down if, in fact, the economy is doing better and inflation is really in check. The fact is inflation really isn't under control. The Fed knows that. They're not going to lower longer-term interest rates because they need them higher in order to keep inflation in check. These rate decreases that they say are going to come really shouldn't have happened in the first place if, in fact, there's a strong economy, if, in fact, the jobs market is growing, if, in fact, these numbers mean anything, and if what the Fed says that, the economy's on a great footing, we're not going to have a recession, we're not going to even have a soft landing, we're going to have just, it's going to be the immaculate recession avoidance program. I don't know how they can, justify getting through that. But the thing is, the stock market already priced in like 7 rate cuts last year. We got 2 short-term rate cuts this year, and now they're pricing in more future rate cuts when they've already priced in more than we've already had. So the market's way overblown, overvalued, overpriced. We've got, fake jobs numbers coming out. And now the people are going, wait a minute, we got fake job numbers coming out. And the Fed says, the economy's really rolling. Good employment or higher jobs numbers might mean that more people employed, more people spend money. That could push inflation up again. Oh, yeah, no kidding. Just the fact that they lowered interest rates and lowered mortgage rates and things like that. And all of a sudden there was a surge in mortgage applications. Not huge, but enough to make a difference, enough to say that, lowering interest rates did help create some extra movement economically. Now you've got to be like, wait a minute, the Fed really doesn't have to lower interest rates anymore. So I think it's more of an election ploy. They say that the Fed is not supposed to be, they're supposed to be apolitical and not really supposed to be party driven. But I know whoever's in the White House, has a lot of influence. Congress writes them letters. The Congress wrote Jerome Powell a letter that said he should have lowered interest rates 75 basis points instead of 50 because they wanted this great, hype rally to go into the election. So everybody doesn't want to change things. And if you look at history, if the market's going up into the election, this indicator works about 90% of the time. So if the market is going up into the election, it's about 90% of the time that the incumbent gets reelected. If it's going down, there's a higher chance that the new person comes in and gets elected when the economy isn't really looking like it's zipping along like they say it is. So the economy really isn't zipping along like they say it is. A lot of these new jobs are second jobs. They used to count households working. That's probably a more relevant number. How many households have jobs? How many households are unemployed? How many people are getting unemployment? There's a lot of people that aren't getting unemployment, but they're adding jobs, second and third jobs. For the last several months, there's been over 8 million people in America that have multiple jobs in order to make ends meet. That's an indictment on how bad Bidenomics is working. It isn't working. It's basically proof that what's happening isn't economically stimulating or economically strong. It's not economic strength. It's weakness in the economy because a lot of people, the middle class people, are struggling more and more to, especially the lower middle class, to make ends meet, to feed their families, to buy gas, to buy food, to pay rent. Heaven forbid if they're renting. If they want to buy a house, even harder with 7% mortgages and prices continuing to go up because the supply of housing is so short. So, we've got a lot of problems that are, facing America, none of which are being acknowledged, except by Trump that's saying, hey, guys, you realize how bad things are. We need to tweak some things to make it all better. I think it's interesting, speaking of tweaking things, the government's doing everything they can, even in spite of the turmoil in the Middle East. Oil, surged recently, but it's softening up lately because, the U.S. wants everything in the world to make it look like things are getting better, right? Gas prices are going down. Look at food prices are going down. Isn't it great? You got to put Kamala Harris in so we can continue, this momentum. But, Kamala Harris was part of the problem that generated all these issues that we're trying to face right now. Although I don't think she's been part of the problem. I don't think she's done anything, good, bad, or indifferent. She's just, spouted off her ultra-socialistic, wacko, woke viewpoints and changes them every time it makes it convenient for her to be on a commercial saying something that hopefully can get her elected so she can continue to be a puppet, as Biden was, on the strings of the cabal that runs the world and trying to control everything. And, it's pretty deep. I mean, it's the thing is the corruption is blatant. They don't hide it anymore. You see BlackRock and Vanguard and State Street trying to buy everything, including housing. They're, interesting that they're involved in so many of these, just the things that are going on. There's some sort of a connection between those big organizations that control all the money. There's Soros. You got him out there pulling his strings. And you've got these people that I think that are bad actors trying to basically usurp control, acquire all the power and money that they can because it's just it's a power trip. It's an adrenaline rush for them. And that's just their whole goal is how can we run the world? And they can use stupid politicians to do it that don't know anything about economics, but somehow put them in a position to enrich themselves or to gain some sort of power and authority and prestige or whatever it is that they're seeking in order to, push through this agenda that really isn't good for America. And it's really sad to see because America is a great country. It's still one of the greatest. I think it's the greatest on the planet. But the direction we're going, I don't know, unless every other country in the world is getting hammered as bad as we are in the negative ways that we're being influenced by big, powerful organizations and people on the planet that really don't have our best interests in mind, but only have their own. And here I go getting a little bit political, but as far as those interest rate cuts, as you mentioned earlier, I think Jerome Powell he never really did have a reason to lower them other than the fact that I think he was pressured to try to keep the market going up because it was running out of steam and they wanted the market to go up into the election. They want a Harris rally if they can get one. The thing is, there's not a lot of fundamentals. GDP is growing based on maybe keeping up with inflation. And most of the stats that I've been reading lately even say in the fine print or somewhere in the paragraph where they report is on a non-inflation adjusted basis. Well, if things are on a non-inflation adjusted basis, then increase in cost of living or increase in wages and increase in all these different things, if they're not inflation adjusted, really, don't mean a whole lot because it's really not a net gain. It's a net break even or even a net loss in growth with GDP, in growth with wages, in growth with, spending power. We're at our lowest savings levels in history, even with good interest rates. People aren't saving to try to capture those good interest rates. They're loading up credit cards to try to pay their bills. Highest defaults in history, record defaults, record debt. Things aren't really looking that great economically, but at the same time, they keep manufacturing jobs to make it look like things are great economically. And if things are great economically, you can't really afford to lower rates. If things aren't good economically, well, they could lower rates in order to push off the negative effects of a deep recession or a hard landing instead of a soft landing. And I think we've got a lot of the underpinnings to result in that. I've said that often over the last year and a half or so on this show, that and to my clients and in presentations and TV shows that I do. So yeah, I've seen this come. There's a lot of reasons that we should fall into kind of a reset period of a recession, but they keep on printing money essentially. And a lot of ways that printing money isn't just, on a printing press and delivering piles of money to banks and other things. They're printing money by manipulating the Fed funds a little bit, but in just what the Feds are doing with banks by allowing them to default on loans that they secured a year or so ago, 2 years ago, on all the defaults that were happening, the things that made Silicon Valley Bank go out of business, all those defaulting loans, commercial loans, mostly as an aftermath of COVID. We had banks forgive a lot of loans or actually pay off some of those delinquent loans so the banks could survive and not more banks would fail. Well, since that happened, they haven't held the banks to any standard as far as repaying them. The taxpayer's basically on the hook for it. And, we're getting the Fed manipulating interest rates and doing different things to make it look like things are better than they are. And a lot of people are just, jumping in. Now, there's two trains of thought. One is, do we see this as kind of fake BS misinformation that's driving the market, and we want to stay cautious and stay out of it because if the truth comes out or if people start believing the truth, the sell-off begins and, we don't want to be in the way and get hurt. Or we say, well, hey, the government is so good at lying to us and at faking us out and continuing to prop the market up, supposedly quantitative easing through the back door and through the various channels. They really are doing that. They pretend they're taking money out of the economy by raising interest rates, but they really didn't do too much. They were giving it right back to the banks and the brokerage firms that kept on buying their own stocks. Companies were still able to do stock buybacks that drove their own stocks up. There's not the fundamentals in the earnings that typically drive stock market increases in existence today. So, we can either hunker down and be safe and not lose money, or we can say, you know what, we believe the government's just going to do QE to infinity and they're going to find a way to do it. And we know the government's not going to let the market crash because the people in power or the powers that be want to stay in power, and there's no way they're going to let this fall. So let's just trust them to continue to prop the market up. So there's two trains of thought. You can either bet on, I guess, the misinformation and the manipulation will continue, or that the market will somehow return to sanity and return to what used to be the equilibrium or the norm, which in history it has done. But I don't know. It's getting so out of control. It's kind of a toss-up whether or not they're going to be able to fake us out of a recession, or if the market's just going to get so full of air, or the balloon's going to get so full of air, it's finally going to just pop. All bubbles pop, and we're in several bubbles. At least that's history. But somehow these bubbles aren't popping, and people are starting to believe that they're not going to. I tend to believe in history more. That's the way I lean. But anyway, that's a lot of information. Interest rates, I think they might stay flat. I think they might be pressured to be lowered maybe one more time right before the election. It's only 30 days away, or less than 30 days away.
Right,
but,
right.
Shoot, what am I thinking, man? It's like 3 weeks. So it's like right upon us. I mean, they might try to do another one right before the election or claim they will, but I think they're going to probably hold everything as is and just talk a big game in order to try to talk the talk, but not necessarily walk the walk. Once the election's over, they can do whatever they want. They can let everything crash. It doesn't matter. Whether Harris wins, she's stuck in there for another 4 years and they can do all the damage they want. if Trump wins, they'll probably try to crash the market and ruin everything they can before he takes office in order to make his job even harder than it's already going to be.
We're talking with Jeff Ogun of Premier Retirement Planning and Wealth Management here in Tucson and also Mesa, talking about the current state of the economy, the rate cuts, and where we go from here. If you like what Jeff has been talking about, you want to have a chance to sit down with him and talk about your journey towards retirement and how all these things will affect you, we're offering you your no-cost, no-obligation, no-judgment retirement roadmap. You can get yours by calling 520-780-9059. Make that call right now, 520-780-9059. It's just an opportunity for you to sit down on a one-on-one basis, talk with Jeff about your concerns about where the market is headed, where the economy is headed, and to get the questions answered that you need to put you on a path towards a prosperous retirement. Again, no cost, no obligation, 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, you mentioned earlier that the presidential election is now probably, I'm going to say 3 weeks away or so. I haven't looked at my calendar lately, but do you think that a lot of people misinterpret the power that the president will have on things like interest rates? I mean, people are putting off purchases because they're waiting to see who's going to occupy the White House. Is that a valid concern?
Well, honestly, this close to the election, it is. We're staying out of the market. It's not that much farther. We're not going to be jumping in the stock market right now. It's like, why not? It's only a month away. You're going to either miss out on a big gain, a big loss, or a little gain or a little loss, but we can just hold our own, and it's not enough time to worry about. And yeah, presidents do make a difference based on the policies and the focus that they have. For example, Kamala Harris is into taxing everybody with money. Tax the rich, make them pay their fair share because they can afford it. You know why they can afford it? Because they worked their butt off. They sacrificed, they invested, they did things nobody else wanted to do in order to get that. And now they just say, oh, well, you did really well because you made really good decisions. You took a lot of risk and you got lucky. So we're just going to take your money and give it to those people that aren't so lucky and help everybody else out that doesn't want to work, take risk, and do those things. That's socialism in its most obvious form. And, I think it can even get even further on to communism, and where we just have zero control left, if they continue down that path. Bottom line is, Trump is based on reducing taxes so people can invest and do more things, and the economy can grow. We saw that happen in spite of COVID. That still happened during those 4 years that he was in the White House. Taxes got reduced. People had extra money to invest in the stock market, to invest in things, to invest in their backyards, in home improvements and things like that, because they were based at home. There was a lot of economic growth during those times in spite of how horrible the times we had and how people were shut down. And there were some bad things, but there was a lot of good things. We were energy independent. We were building a wall to keep the illegal immigrants to a minimum and decrease the problem of illegal immigration, people coming and taking the Americans' jobs, into, being a big drain on everything from FEMA funds to other things that should, the other taxpayers' monies that should be used to support Americans, not illegals that didn't do anything to earn it or pay into the system. I mean, they're getting Social Security, they're getting monthly living expenses, housing, travel, free of charge. Based on what? Based on just the fact that, we can afford it because we're Americans and we all pay into a system and they can give our money away. That's crazy. But that's the current state of affairs. And in spite of that, even with this, somehow Bidenomics, it isn't working. It's hurting the middle class person. But somehow they're at the same time, they're orchestrating this manipulation of the stock market to make all the rich get richer, the poor getting poorer, separating the classes. And, Marxism 101 is divide and conquer, right? That's that's kind of their agenda. And you can divide it by two different things, not just politically with different viewpoints on who you're going to vote for or what your party believes, but what about socioeconomic stuff? Divide us economically. It's rich against the poor. The poor want all the rich money. The rich people say, gosh, earn your own. Here, I'll give you a job. We don't want a job. We just want to take your money. That's what the government kind of pits them, those people that either haven't worked, or there's a lot of people that also, I wouldn't say that all of them are just lazy, low lives that didn't make good decisions. I think many of them are, but a lot of them, it's just due to unfortunate circumstances. I have no problem helping people with unfortunate circumstances, special needs kids, for example. I had one. People that can't work, people that are reduced, from their job because maybe AI takes over and there has to be some retraining. I think government, I'm happy to pay for those people to get retrained so they can become productive citizens in a new area, like maybe fixing the AI stuff or being, technicians or something instead of, warehouse workers or whatever it is that they're moving from. But I have no problem growing the economy in a productive way with my taxpayer money, but just doing handouts and making people mad because I've worked hard and I have stuff and they don't, so they should have some of mine just because the government says so, is another way that they can divide and conquer and create, I don't know, that bad feeling towards one another. I think that's where we're headed, unfortunately, especially if the present party stays in power. And I think there's going to be a lot of, negative things ahead and really hard times ahead for most of the American people, other than the rich, who she says she's going to tax the heck out of. She's going to basically be getting rich on all her inside information and doing her own little side deals anyway, Harris and her husband and her entourage. So they're not going to end up taxing the rich. They're going to end up taxing the middle class people and just redistributing the middle class. The rich are going to stay rich. Every time they say they're going to tax the rich, they end up not taxing the rich. And I'm talking about super rich, the billionaires. There's always going to be those tax havens, those tax strategies. We use some of them for our middle class clients too, as much as we can. Obviously, we're not running hedge funds and doing certain kinds of tax hedge like they can use, but we can still do our best to minimize taxes, even if we're middle class, and especially if you're middle class. We know that you've got a problem if Harris wins, a big problem. If Trump wins, you've got less of a problem, but I think there's still going to be a lot of problems because the ball has already been in motion, where there's so much extra spending that we got to dig out of. There's going to be some difficult times ahead where we may have to come up and pony up a little bit. Hopefully not a lot, in order to make some adjustments. I think cutting government spending would be a first start, but man, once you're a government worker, they can't fire you. They can't get rid of the bureaucratic mess they create. So I don't know, how fast or how efficiently they can drain the swamp and get rid of the fat that they've created, all these extra government jobs. 60 to 70% of the jobs that are created are government or healthcare, which are basically subsidized by government and taxpayer money. So how to undo that? I don't know. It's going to be a lot of work. But if, the Harris-Biden ticket stays in power, which is still being directed by the same puppeteers, it doesn't matter if Biden's in there, Harris is in there, or anybody that they put in is in there. If it's that party, they're going to continue the same power-mongering agenda that hurts America. And, we got to kind of look at that. Now, that might mean, hey, the stock market is going to go up because they're going to continue to manipulate it. If we've got money, throw it in there. If we don't, we better hunker down. And, with Trump, we might be able to feel good about making business investments or growing our family business a little bit, or investing in ourselves or other things, just because we know that the taxes aren't going to wipe us out and we're going to have a chance to succeed. It's funny that Harris talks about supporting small businesses and making the small middle class succeed. And it's all about making small businesses thrive and giving them free money. They're getting even tax deductions and stuff. We already get tax deductions. So there's really that's a nothing burger, what she's saying. It's just a bunch of crap to make everybody think she's not as radical left and as far left as she really is. We'll see what happens in the election. I think a Trump win solves a lot of problems as far as the anxiety that people feel in America, at least the majority of the people. And I think there's even a lot of people on the Democratic side that know better, but are scared to vote for Trump, either because they're brainwashed or because, they're true blue Democrats and they defend their family or something like that and couldn't go to Christmas dinner anymore or whatever. I think people need to use their brains and understand that what's good for Americans in general is typically good for them too. Not just what's good for the rich or good for the poor or good for their class or good for the other class. That's division. That's the divide and conquer. That's the Marxism. That's the socialism that we don't want in there. But I think America is on a bad track if we go that direction. It doesn't mean we can't make money. It doesn't mean we can't survive in retirement. It doesn't mean we can't make good investments. It doesn't mean we can't make good choices with our money. But we have to do it with the knowledge of who's in power and the type of agenda and the type of policies that they're going to create in regards to our money and our investments and our future and our tax situation and so forth.
That's the voice of Jeff Ogun. Premier Retirement Planning and Wealth Management is the company. Our show, of course, is called Premier Retirement. If Jeff's comments resonate with you, you'd like to get in and sit down with Jeff, ask your questions about your retirement plans, how you should react or not react to what's going on in politics or in the White House at this point. Really, basically any question that you have about retirement planning and getting you on a path towards a prosperous retirement. You can call this number, 520-780-9059. Do it this weekend while you're thinking about it. Leave your name, telephone number. Shelley will call you back. You're requesting your retirement roadmap. It's a 5-point retirement review that you'll go over with Jeff. It's an income plan, investments to support your income plan, also a tax plan, health care cost, and estate plan. Totally comprehensive and totally cost-free, as in no cost, no obligation. 520-780-9059. Make that call this weekend while you're thinking about it. 520-780-9059. And remember, this one call really could make all the difference. Jeff, time for a break. When we come back here on Premier Retirement, we'll answer listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059. or request it online at premred.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us here each and every week for Premier Retirement with Jeff Fogan. And a reminder, we're on the radio for you 4 times a week, Saturdays at 7 a.m., also 9 a.m. and 1 p.m. We can also be heard on Sundays at 11 a.m. And as always, if you've missed any part of our program, we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Again, our telephone number right now, 520-780-9059. Use that number to call right now and request your no-cost, no-obligation retirement roadmap, just a casual conversation, 520-780-9059, and you can do it right now. Time for listener questions, Jeff. Our first one comes from Frank, who's listening to us in Tucson, and Frank says, I'm 54 years of age, I'm in great health, and I plan to retire at 60. I have $3 million saved for retirement. Should I still consider long-term care insurance?
I hate long-term care insurance in the traditional sense of pay as you go and see if you use it or lose it type policies. The industry has been so horrible at raising rates the older you get to where some people just say, I'm not going to fool with it anymore. I'm going to just not pay for this stupid policy anymore because I seem to be healthy and gee, all my family seems to die in their sleep and not go to nursing homes anyway. So forget it. I'm just not going to do it. And then they end up dropping the policy after they paid for 10 or 20 years. Now, I do have a way that can work itself into a retirement plan. We use it all the time. I think long-term care insurance is going to be one of your biggest bills besides taxes in your retirement, I'm guessing. $3 million saved for retirement. I don't know if that's all in qualified /IRA type accounts, or if it's been taxed previously as Roths, or if it's traditional where it's going to come out taxable. If you look at $3 million saved for retirement, you're 54 now, you want to retire at 60, I'd say you're going to get probably somewhere in the neighborhood of $10 million in potential income if you want to, use those funds throughout the rest of your life, which is a pretty, healthy lifestyle, probably $200, $250 a year spendable if you want it. That'll probably cover, most nursing homes if you're not eating at home or dealing with, life outside of the nursing home. So, and if you have a spouse, I don't know if your situation is married, single, or, could be different in the future down the road anyway, but either way, I think you could easily pay your way. However, I think there's more efficient ways to pay your way. One of the things I've talked about often is indexed annuities and also fixed index universal life, or just index universal, IUL, which is LIRPs, life insurance retirement plans. Now, we know that long-term care insurance is offered by life insurance companies. So we're not dealing with a different company. We're just dealing with a different model within that company to deal with your program. How would you like a situation where if you don't go to a nursing home, you get all your money back plus everything that it made? How would you like to get all your money back while you live tax-free, and then when you die, the rest of it goes to your heirs tax-free, including all the gains that you made on that asset? You can do that with IUL, LIRPs. It's very common that somebody with a $3 million estate would put about $1 million away in a LIRP, maybe a third, and have somewhere in the neighborhood of maybe $70,000, $80,000, or $90,000 a year in income. After funding it over the next 5 or 6 years, you would have to pay taxes on that money. But guess what? You don't pay taxes on maybe $2 or $3 or $4 million that you might be able to get out of that policy over the next 30 years or so, based on the growth, based on the fact that you actually take a loan against a future death benefit. Now, that death benefit is what life insurance is all about, right? You buy a death benefit. Well, what if you overfunded it with a lot of your money to where the interest on what you put in there more than covered that death benefit for the rest of your life? Well, then you can go ahead and spend that death benefit. Whatever's left of that death benefit ends up being available to you should you go to a nursing home. And again, tax-free. You've already paid for it. It's called asset-based long-term care planning. So that's one method. There's a few companies that offer some sort of a deviation of that. Now, a lot of people aren't even able to get long-term care insurance because of a health issue. They don't think about it early enough when they're healthy. They think about it after they have their first hiccup or heart attack or something, and they say, oh, I want a long-term care insurance. Guess what? You can't get it. Or maybe you just have a health issue. Maybe you're diabetic or something, and it's just not a very good, wouldn't get a very good rate for that insurance policy. You wouldn't get a very good rate on the long-term care pay-as-you-go policy either. If you can't, then there are annuities that would possibly double or triple the value of that annuity if somehow you went to a nursing home. Now, it would cover you over a period of time, so it's very unlikely that you would actually get double or triple your actual account value out of it. But it would be possible if for some reason you stayed a super long time and if the policy was set up right and if you bought it for that specific purpose. There's even one that I know that just came out with kind of a new nuance of it. They blend it with kind of a standard issue life insurance policy where they actually do a little bit of underwriting. They'll do it standard without underwriting too. But if you do it with underwriting and you qualify, they actually put it into a life insurance sale. So it's like an annuity where it grows. You still have access to the cash if you want to use it for income. And whatever the death benefit or that account value is at the end, when it pays out to you, it pays tax-free because it's a tax-qualified account towards long-term care. But whatever's left in the account ends up going to your heirs tax-free. So some people really don't like annuities with after-tax money because if they don't use it, let's say they put $400,000 in it and it's worth $1 million when you die, guess what? Your heirs get to pay tax on the $600,000. Well, that $1 million could have been used for long-term care tax-free, but it was passed on, and since somebody else got the benefit of the profit on a tax-deferred account, they have to pay taxes. Well, there's some that are structured in a way where they would not have to, where your heirs would not be burdened by those extra taxes. So there's a lot of ways to skin that cat. I don't like the standard long-term care insurance that most people just sell. It's just a crapshoot whether or not you're going to use it. All you know is you're going to pay in. You never know if you're going to get anything out of it. The other thing is with $3 million, I don't see a situation where you couldn't at least make minimal interest, and just the interest alone on that $3 million would cover long-term care in a few years should you need it. And we're not even talking a few years. You're 54 and you're in good health. So, maybe when you're 80 or 90 or close to 100, you end up having $10 million of assets, and interest on that could be several $100,000 a year and more than cover a long-term care facility stay. So I'm not a fan of the pay-as-you-go. I'm a fan of several of the alternative ways to basically create an income plan, create a tax-efficient retirement plan that includes a provision that if you go to a nursing home or need some sort of home care, that is covered in a very efficient, tax-efficient way.
Frank, thanks for listening to us here in Tucson. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Ben in Sam Hughes. Ben writes, I'm 68 years old. I don't own any real estate. I rent a home for $2,000 a month. I am divorced and have 2 adult children. I'm on Social Security of $1,800 a month and have approximately $750,000 invested. I continue to reinvest the dividends and interest so my investments continue to grow. I feel like I'm missing something. Besides a will and healthcare directive, I'm curious to know if I need to add a revocable trust.
Doesn't sound like there's really a need for the trust, although you do need the health directives, powers of attorney, and you probably ought to have a backup will just in case for some reason something has to go to probate. I hope it doesn't. But if you have all your investments put in a POD or pay on death account or have a beneficiary listed, they'll skip probate just by virtue of the fact that there's a beneficiary and there's direct succession on that asset. You can do that on your bank accounts. You can do that on your investment accounts. I would say that based on your rental situation, you're going to have probably some increases in rent. You also get less Social Security than the rent. The interest and dividend income on that $750,000 has probably been really, fairly robust the last 10 years. But if there's a big market correction, dividend stocks sometimes take the worst hit. So I'd be careful as far as how that investment is lined up. I would say that if you're 68 and if you wanted to put $500,000 of that in something that would guarantee lifetime income of somewhere to the tune of $40,000 or so per year, starting almost immediately, and still have $250,000 that you could leave at risk in the market, because anything in the market that pays dividends typically is a risk investment, a security, as they call it, which isn't really secure. It's actually a risk investment. But, for an extra, $3,000 or $3,500 a month, that would put you in great shape, I think, to pay all your bills, know that your bills are getting paid, know that you don't have to worry about where next week's check's coming from. And if the market does end up going through some sort of recessionary or correction period, or if we get a lost decade like we did 2000 to 2010, and based on where the market's priced, I think that's very possible. And history says it's probable. So that we'll have kind of a lost decade. So you might not make a lot on that 750 if it's invested in the market over the next 10 years. You'd just be drawing it down. And if you live long enough, that could mean trouble, especially if you're drawing down 40,000 a year or so. That gives you, you're 88 years old, you're out of money. If the market crashes, you could be 70 something and run out of money. So I think locking in something that provides guaranteed lifetime income would be extremely important for you. And I'd probably look at about 2/3 of what you've got invested as that income driving source, and do it with a good A-rated company that guarantees income regardless of performance on that particular investment that you make. Now, I would say they're not going to give you good income unless they know they can make a reasonable rate of return on your money. But look around. We have some that we really favor that do very well as far as growth on the account, as well as create great income. Other companies will give you really good income, but guarantee that you're going to be out of money on that $500,000. If you're divorced, have 2 adult children that are taking care of themselves, you don't really have anybody to take care of or leave money to, maybe you want a little bit more income and you're willing to take your chances on just a pure straight life income annuity for part of that, maybe make more money than, what I just quoted. It just depends. There's a lot of ways to skin the cat, so to speak. There's a lot of ways to plan your retirement. I think security, peace of mind, not just predictable income, but guaranteed income and some sort of predictable returns make a lot of sense.
Ben, thanks for listening to us, and Sam Hughes. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. You're listening to Jeff Ogun of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're answering listener questions. If you'd like to get in and sit down with Jeff and talk about your individual situation, get your personal questions answered, 520-780-9059 is our telephone number. Next question, Jeff, is Stella in Catalina Foothills. Stella says, I'm 80 years old. My husband is 72. We have about $200,000. We took it out of an account because our advisor put all our money in mutual funds, and the only person making money was our broker. We lost $2,000 in my husband's IRA after it had been open for 5 years. So I fired him and put the money into CDs. We live on Social Security and we have no debt. We live pretty comfortably on this budget. Should we put money in double-E bonds, annuities, or something else as they mature?
It depends. I think based on the fact that you have limited assets, I think keeping them safe makes a lot of sense. I don't know that you'd be served well unless you're 80 years old. I mean, I think based on the current CD rates, you're doing really good. I think short-term bond accounts, if you wanted some liquidity, might be a good place to put it too. I would continue to ladder the CDs like you're doing and just have them every time they mature, just look for an option. I don't like I'm not a fan of double-E bonds, actually. I think annuities typically are a little bit longer term than you probably want. Maybe you could structure an annuity for maybe half of that money and then put the rest of it in high-yield savings accounts that making, somewhere between 3 and 4 or 5%. CDs are probably going to start dropping in interest because the Fed is lowering short-term interest rates, and CDs are typically shorter term. So, the fact that you're living, within your budget, that's great. $200,000 is a nice buffer for those things that could come up. I don't know how you're set up for a long-term care situation. I know the VA doesn't always have, long-term care availability. They've got good health care generally. That might be an option you want to look at. Maybe make sure that your home is home health care friendly, and you can use some of those funds for that in the future if you the key is with that kind of money, you don't want to lose anything. And if you lost even a couple $1,000s, in a 5-year period, I understand in a 1-year period you might, but after 5 years, we should be able to at least get you better than break even, I would think. So anyway, I think you're probably right to fire the broker, and might have been a number of circumstances that caused that situation. Maybe picked some bad funds, maybe didn't have really good supervision, maybe wasn't watching your account or keeping it in line with what your goals were. Maybe it was taking more risk than you wanted, and maybe you just needed to talk a little bit more and have better communication over time. So I don't know, if you're unhappy, you should leave, obviously, and go somewhere else. But you're in a situation you can probably do pretty well on your own safely now that the short-term interest rates are higher, and you can actually do okay at the bank and keep that money kind of close to the vest here and keep it close to you. The other thing I would say when I mentioned the long-term care issue is, that's probably the next big expense besides, paying taxes on your money over retirement. The next big whammy is going to be, what happens when I get too old to get around like I used to, and the body just starts giving up, and I need some care. You can do it in home and fairly cheaply for a while, but as things need more and more care, pretty soon you graduate to either full-time care or have to go to a facility. What's the equity in your house look like? Have you looked at that as a possible fallback if somehow the $200,000 isn't enough? You might even consider doing certain kind of trust that would at least protect half of the assets for each spouse, so that if one spouse went to a facility, a nursing home, and needed all the assets, that you wouldn't be out of leaving the surviving spouse destitute. So there's a few things to look into, but that would probably be the only hole I would see. I don't think you're wrong for firing your broker if he wasn't serving your needs. And I think you could probably do just fine on your own with the CDs and short-term investments.
Stella, we appreciate you listening to us in Catalina Foothills. And, of course, you'll get Jeff's book, Retirement, The Road Ahead. If you've got a question for us, you can get it to us 2 ways, one of which is to call in to Shelley. 520-780-9059 is our number. You can also go to the website, premret.com, and use the contact page from there. If we use it on the air, of course, we'll send you out Jeff's book, Retirement, The Road Ahead. You can also use that number if you'd like to talk to us here at Premier Retirement. Sit down with Jeff and have a conversation about your journey towards a confident retirement, and ask any questions that you need the answers to put you on that successful path. Once again, 520-780-9059, or again, online at premret.com, PREMRET.com. PremierRetirement.com. Jeff, a little more time left in the program today. You know, we talk all the time about this Premier Retirement Roadmap and what's involved with that. It's a 5-point retirement review, so I want to go over it a little bit for those listeners who do not know what it is. It involves an income plan, investments to support the income plan, taxes, health care, and estate plan. So first off, let's start with the income plan. How do you determine how much someone's going to need in retirement versus when they were working?
Well, there's two things. Sometimes people come in and say, hey, I need this much to live on. And some people say, I have no idea if I could even retire. What's a realistic income based on the assets that I have? And so it's two-part. One is, okay, what are your bills? What do you know you need to spend as far as a spending plan? I hate to call it budget. But we kind of start there. What do you live on now? And then we say, okay, great. Can you retire? You know, if you're living on $180,000 a year and you just can't dial it back at all, and you've got less than $1 million saved, I'd say you're going to have a hard time unless you have a big pension to do that. Maybe you need to work another 10 years and save a little bit more. Maybe you're at a high income level where you only need to make 5 years and do some things that'll make it all happen. I mean, I saw somebody recently had over $3 million in savings and, you know, could live on $3,500 a month. It was like, well, why don't you get a hobby, or why don't you take some trips? And the wife's going like, yeah, you miser, you know, why don't you loosen up a little bit? And so I'll build a plan based on, you know, do you want to leave a legacy and not spend your money? Do you want to spend as much as you can and leave nothing, spend every last dime? You know, what are your goals? And so the big part of that whole plan is just really some people call it a discovery meeting. Some people call it a fit meeting. I just call it a, retirement planning review session. Let's just get to know each other and let's find out what your goals are. And, by the end of the first visit, I'll know whether or not our capacity is, a fit for them, and what we do in our value system is in line with their value system. Some people just want to swing for the fences, take all kinds of risks and say, well, as long as you can guarantee me at least 8% a year, I'm good. I was like, what, every year? I mean, there's really nothing that guarantees 8% every year. You have to take some risk to get that. And you might lose 30 or 40% in a bad year. You might gain 30 or 40 in a good year, but it might average that. But is that a good plan? No. I mean, you're holding me to a standard that nobody can keep. So I'm not going to probably go down that road. If you say, hey, this is the income I need, how do I secure that to where I know that my Social Security that I believe in, hopefully we believe in that for a while, my pension, which I think is secure and I can believe in, and then I've got this money saved up. Maybe it's a few $100,000 or a few million, whatever it is. I want to make sure that I set aside some of that for my emergencies and the what ifs, and I don't want to take risks on all of it. I want to make sure that some of it fills the gap between Social Security income, which might add up to, let's say, $50,000 a year. And, I need another $50,000 a year just to make sure I have a, kind of that round number of $100,000 a year paying the minimal expenses. And then what's left, I can, make more discretionary decisions on, and also more discretionary investment decisions. It's funny how a lot of people, they always want to make money. They're always sad that they're not, killing it like the market, but boy, they sure don't want the risk that's associated with it. I'll ask people, okay, great. You want to make a 6 or 8% rate of return. How much of this money are you willing to risk losing? Well, none of it. Okay, well, then you want something that's not realistic right now. If you say, hey, I'm willing to risk 40% of it, as long as that 60% of my assets will create enough income that I know I'll never have to worry about missing a meal or missing a trip to see one of my kids if they, have a kid and they're in Florida or whatever, or to help them out if they, have a rainy day and need a little bit of help. If you can structure it to where you can afford to not use a chunk of money, then that's the amount that you should feel comfortable with, maybe, going into some sort of risk-adjusted type of situation. So, everybody's situation is going to be a little bit different. Some people are going to have unrealistic expectations. Honestly, more often than not, though, I find that people have kind of an idea that they're not going to be able to retire, and they're scared that they're not going to be able to make ends meet. And what we find out is, as long as you secure some of the income in truly retirement income products that provide that income on a guaranteed basis, and others on a fairly secure and very predictable or fairly predictable basis, if you can kind of ladder those guarantees with probables and maybes and kind of allocate them based on highest and best needs first, and then those what ifs, discretionaries later, or just say, you know what, I don't want to risk anything. What's the most I can count on a monthly basis, period? And we can structure that plan too. So again, it just kind of depends on what you're looking for. Do you have a tax problem if we do it your way? Do we want to mitigate a tax problem and do it my way? Because we're really good at looking at the tax situation. We might restructure some things where it means you pay more taxes for a few years, so you pay less taxes for the rest of your life. Or we might say, you know what, while you're working, you're in too high of a tax bracket to do any Roth conversions or anything that you'd have to pay taxes on it right now. Let's wait till you stop working and you're in a lower tax bracket, and then we'll do some tax mitigation programming at that point so that we can minimize the taxes between now and the time that you eventually pass on and leave those assets behind to your loved ones. So it all starts out with a conversation depending on what you want to do. So after we get the income plan, as far as we know where we're going to start, we pick the products and services, we find out what your risk tolerance is, and then we make investments that coordinate with that income plan or those needs or how much guarantee you want in that income plan. We also minimize taxes. That's the third pillar of planning. We have 5 pillars. First is just, what about retirement income? What can I count on? What can I bet on? And what can I secure in a different type of investment opportunity? Then we work at those investments. We work a tax situation. Then what if I go to a long-term care facility that costs $100,000 or maybe $200,000 a year by the time I need it? Do I have enough equity in my house that I can downsize and just move in? Do I have enough assets that I can set aside that will pay those bills? That won't affect the livelihood or the ability for my surviving spouse to survive, or will it decrease the legacy that I plan to leave my grandchildren for their college scholarship fund or whatever? Where are those assets? Can you use a LIRP or some sort of an annuity that has a long-term care benefit that adds extra benefits should you go to a nursing home, so that you don't have to pay for those costly insurance programs that you pay into and never use, and then you end up just being out the money. Once that's done, we pretty much got the plan pretty well taken care of, but there's a 5th pillar. What do you do when all is said and done? What's your legacy? How do you leave it? Do you have a trust? Do you have something that'll avoid probate? Do you have all your beneficiaries designed properly? Are you using a beneficiary deed so your house can pass directly to your heirs instead of go through probate? Do you have living probate documents? What I mean by that is, what if you become incapacitated and can't take care of yourself? How do you give that control to somebody else without them having to go to court and get a conservatorship proceeding to get that control? Well, powers of attorney work. So you should have those things. And that's part of the estate plan. Do you want to give money to a charity? Do you want to leave it all to your kids? Do you want to spoil your grandkids up and forget your children because you've already spoiled them? Whatever your goal is, we want an estate plan that leaves that succession plan in place for whatever's left of your assets. Now, of course, there's a spend every last dime plan. We could do that one too. But, for those people that don't have kids or loved ones or everybody's well taken care of, maybe you'd rather spend a little bit more, have a little bit more fun and leave zero. And maybe just a little pittance for the church or charity of your choice if there is anything left, whatever. Everybody has a goal. Everybody has an idea of what they want. Our job is to figure out how each part of that plan fits together. All the pieces have to fit together just like a puzzle. You see the picture on the top of a puzzle box, you look inside, there's all kinds of pieces. You have to figure out how to put them together so it makes that picture look pretty. And that's just like a retirement plan. We have to put the pieces together, make sure that they fit just right, or the future picture of your retirement isn't as pretty as it could be. As long as the pieces are fitting together, it'll look better.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management. We're talking about this 5-point retirement review that you can get at no cost and no obligation whatsoever. If you're seeking someone who can clearly give you the facts as they are, we can give you access here at Premier Retirement to a wide range of products and services. We're going to take a neutral approach to find the right solution for you. So once again, take advantage of the opportunity to sit down with Jeff and talk about your needs and concerns, your visions for retirement. You can get that plan, no cost, no obligation, 520-780-9059. It's 520-780-9059. Make that call right now. Phone lines are open. Leave your name, telephone number. Shelley will call you back and set up a time that is convenient for you. Again, you can make that call right now, 520-780-9059. You can find out more about us online at premret.com, PREMRET.com. Jeff, out of time for this week. Thank you so much for your time. It's been a really enjoyable visit with you, and I want to thank our listeners here in the greater Tucson area for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.